Shark Tank star Kevin O'Leary joining me now on the floor of the New York Stock Exchange. He's also the chairman of O-Shares ETF Investments. And Kevin, you're fired up about tech stocks. You have a new ETF. It's called the O-Shares Global Internet Giants ETF, ticker OGIG. What's the criteria here?
OGIG looks for the companies that are growing the fastest all around the world, not just domestically. So, you know, when people talk about Facebook and Google and Amazon and Microsoft, in other geographies, there's equivalent companies. It's just like Uber invented ride-sharing, but it's not the biggest ride-sharing service in China. That's Didi. So the whole idea is with OGIG is to find those companies globally, not just domestically. Yes, you own the Facebook. Yes, you own Netflix. Yes, you own Amazon. But what about all the others? There's a total of 50 companies around the world that are global internet giants, and OGIG owns them all.
You mentioned Netflix, a stock that has doubled so far this year. Any expectations for earnings later today?
I own it, obviously, as many others do. Until the metrics change, until the fundamentals change, I don't see the narrative changing on Netflix. People have been trying to talk about its valuation for 4 years now. They have found a model that continues to grow, but not just domestically, globally. And so until I see subscription growth slow, I won't be selling it.
And I guess I have to ask you the same question about Amazon, a stock that's, over $1,800 a share. Is
Yep.
that getting a little bit expensive?
You know, Amazon has a really interesting proposition to everybody because the Prime model keeps getting more valuable. They've just proven they can raise prices on it. They had practically no attrition. And it is, as everybody agrees, disrupting e-commerce. But if you're going to be part of looking for companies that are growing at 20 and 30%, you're going to put Netflix and Amazon in your portfolio. Yes, you can hold your nose on valuation, but the point is, where can you get that kind of growth anywhere else on earth? So that's why they deserve a place in OGIG.
You launched O-Shares ETF Investments 3 years ago. You
Yeah.
have a host of ETFs, not just OGIG, but you have a small cap one, a large cap one, an international one. Are there certain investing themes that you apply when you design one of these ETFs?
It's across the same metric in every one of my ETFs. I'm all about quality balance sheets. I don't care what sector you're looking at, there's always a good balance sheet in that sector and a bad one. So if you're looking at, let's say, OUSA, which really is a subset of the S&P 500, 600 stocks, I want the ones with the good balance sheets, the ones that have really good return on assets, that are increasing cash flows, that are increasing distributions back to shareholders. That ends up being about 138 out of 500 names. I'd rather own those because they're the quality balance sheets. The same in every sector. OEUR, which is Europe, the quality balance sheets in Europe. OASI, which is Asia, the quality balance sheets of Asia. And now OGIG, the quality balance sheets and growth, revenue growth of internet companies. It's all about, to me, I'm worried about preserving wealth, not necessarily always outperforming. I want to preserve it because markets are volatile. When they go down, you want to have high quality balance sheets.
Although let's talk about outperforming, because OUSM, to your point, the higher quality companies in the Russell 2000, you've been talking about the small cap rally for a year now. That forecast has certainly played out. Do you think that positive sentiment on small caps will continue this year? Do you think we get more of a rotation into the large caps, which are of course benefiting from earnings, as we'll hopefully see over the next month?
Well, there's a challenge within the small cap arena because the Russell 2000, which is the well-known index, includes many, many companies that are REITs that don't benefit from tax reform and many companies that make no money. There's no benefit to a company's tax reform if they're not making any profit. If you're losing money, you don't pay taxes. So OUSM is an attempt to take the Russell 2000 and find the companies that are not REITs that are making money, and there's only 338 of them out of the 2,000. So that's what you own when you own OUSM. It's a redefined vision of what small cap is. And no, I don't see the trend changing because it's not really tax reform that changed the small caps, it was deregulation. The tax reform really hasn't played itself out yet. Most of these companies haven't even seen the tax code rewritten yet. It's coming in the next year. So I think the trend stays in place. I think it'll continue to outperform for another 2 years.
So with those themes in place, what's next for the S&P 500? We're dancing with 2,800. We crossed it on Friday. I mean, where do we go in the coming months?
I think there'll be more volatility based on the trade debates, but if you're a sovereign wealth fund, and I talk to those guys all the time, you're trying to look out 36 months. And most people feel that are investors, and why you haven't seen the market really correct, is that the trade skirmishes are not really a trade war, it's a negotiation. They figure in the next 3 years or 2 years, most of these bilateral agreements with other countries, whether they be called NAFTA or not, or the European deal, or the UK deal, or the deal with China, will be worked out with Wilbur Ross and Kudlow and their teams. and we'll come up with a more standardized tariff program where it's more equal. And I think that would be good for the S&P, which is why you haven't seen the market take a correction yet. People are willing to wait out the nastiness of the negotiation. Doesn't mean we won't have volatility. I think we'll have lots of volatility, and maybe that's a buying opportunity.
And there is, of course, sentiment that maybe the U.S. can win a trade war with China if it did come to that. I mean, do you share those thoughts?
I don't think it's about winning or losing a trade war. What we're trying to do here is simply standardize equal tariffs. If you want to charge 10% on a car leaving Detroit and going to Shanghai, then that 10% is going to be on the car coming in from Shanghai to Detroit. In the end, it's better to have no tariffs, but at least if all we did was normalize the tariffs so that they're equal, that would be better for everybody, and I think that's the first direction. You know, what happened up in Canada in the last few weeks when Trump talked about removing dairy subsidies, there's 270% subsidies in exchange for maybe removing tariffs on aluminum and steel. Those are the kind of negotiations that go on with Mexico and Canada. Same thing with the UK, same thing with Europe. All the other administrations, and I'm not trying to be pro or con any political diatribe, but I'm just saying, listen, everything else tried in the last 30 years hasn't worked. This is a different attempt to do it. And so far, it's getting really interesting. I'm more interested in policy. I'm interested in what Ross does. I watch what Kudlow does. Those are the actual mechanics of this trade dispute. And Trump has sort of said since the day he went on in the beginning of his campaign, I'm going to fix it. This is his way of trying to do that.
As someone who is from Canada, I mean, what do you make of the negotiations when it comes to NAFTA? How do you see that playing out?
The biggest trading partners across the friendliest border, Canada and the United States, we got to work this out. I mean, there's no way the automotive industry can sustain tariffs. It'll make every F-150 truck or every model built on both sides of the border more expensive. I'm going to make the assumption, as many investors do, that between Canada and the United States, they're going to work out a deal. This is just the beginning of a negotiation, and I bet you by the end of the year, you've already started to see that happen. Right now, we've got a tour going on in Helsinki and in Europe, and what happened in North Korea, that's taking the limelight, but the Mexican and the Canadian NAFTA agreement will be back on the front burner probably in the next few months.
Moving aside from trade for a moment, the other risk on the horizon for markets is, of course, the flattening yield curve.
Yes.
Right? We talk about the spread between the 2s and 10s. Is that a worry for you? Is it overblown? How do you see that shaping up in the coming months?
I think that it will give the Fed pause when they look at a potential inverting if they see an inversion coming, I think it pulls them back from the brink of more rate hikes. So they don't want the yield curve to invert, in my view. So I think maybe the benefit of this is you don't see as many rate hikes in the next 18 months. I think the fixed income market's telling you that, Scott, because the 10-year is doggedly staying below 3%. And so, you know, I'm an optimist, let me put it to that way. It doesn't make me reduce my equity exposure yet because we have, perpetually low rates, which has been very good for earnings, and earnings for this quarter are going to be really good. So that's another reason to hang in there to see how they come through.
So would you put more money to work right now, or how would you allocate your cash? I mean, where do you come
I
to
have
this
put more
decision?
money to work, but not in large caps. I put more money to work back into OUSM because I love the small cap, dialogue. I love reform and tax reform working together. I think some of those companies are going to increase their cash flows from 15 to 20%. I want to be there. It's already outperformed the S&P. I think it's going to continue to for the next 18 months.
And then, Kevin, before we go, I always like to ask you about financial literacy. You do so much work in that space with your Beanstocks app, which lets you buy a fraction of a share of stock.
I'm very proud of that.
What's the latest on that?
So Beanstocks continues to grow. It continues to do one thing well. It helps millennials, or anybody for that matter, take small amounts of dollars and buy fractional shares to learn how to invest. I don't care if you put $5 or $10 aside every month. You're building a portfolio, you actually own the ETFs, you own the stocks, you watch the dividends come in, you watch the market go up and down, and above all, it lets you watch it grow. If everybody put 10% of their income aside from the day they got a job in their 20s, they'd have over $1 million in the bank if the markets just continue to do what they've done for the last 100 years, give you 6 or 7% a year on average. People have to invest when they're young, and they've got to stay the course. That's what Beanstocks helps. BEANSTOX.
Well, we talked about, some of these stocks like Amazon earlier, $1,800 a share. With Beanstocks, you don't have to worry about that
You
per
could
se.
put $5 in Amazon and actually own an Amazon fractional share, watch it move up and down. For the stocks that pay dividends or the ETFs, there's all kinds of ways to learn how to invest. I prefer this platform to just a robo which you're not really thinking about what you're doing. I'd rather you understand that's a stock I own, that's an ETF I own. I can watch that individually, and portfolio analysis comes into your head. You start to think like an investor.
All right, Kevin O'Leary, it's always great to be with you.
Thank you so much. Enjoyed it.